The Fed has been extremely clear despite the lack of transparency on the data, right? The data is still quite difficult to read. I mean, we are still seeing very resilient CPI. CPI is converging, but it's not converging at the pace we all wanted, especially the Fed. But the Fed also acknowledges that a lot has happened in terms of financial conditions tightening. The last media conference, I have to say, out of, whatever, 60 minutes, 50 minutes, we probably talked 25, 30 minutes about media and Powell himself talking about financial conditions tightening, right? And he made the point that, it's probably, a lot has happened, but it's also volatile. We have to understand, how structural this movement it is. So I think that the Fed is pretty much trying to tell the market that, hey, we are not going to cut anytime soon, right? But probably a lot of the tightening effort already has happened, which is positive for risk.
Oh, well, let me unpack that more, because my next question to you was going to be, how can EM perform in a market where we are in a higher for longer rates environment? Do rates need to be cut in order for EM markets to start performing again?
Many EM jurisdictions, they acquired this license to cut because they had to hike so much. And the upside in inflation happened, actually earlier than the upside in the U.S., right? Brazil is a case, right? So, I think with the beginning of the easy cycle will be a lot easier. But as we go into 2024, it's going to be more difficult. The non-core components, energy, depending on what happens to El Nino, food components, they will probably pose a challenge to central banks. We do believe that the beginning will be probably, I wouldn't say autopilot, but it's definitely easier for some central banks to ease policy now, independent of what happens to the Fed. But as we go into perhaps mid-2024, I think that the story, there will be a lot more dispersion among EM jurisdictions in terms of monetary policy, which will be great news for investors. Great news for discretionary investors. And this is one of our major calls. It's going to be a lot more difficult to trade EM from the index perspective because there will be a lot more differentiation.
Interesting. Well, when it comes to differentiation, over the last couple of weeks, we've watched the price of oil come down, which obviously has very different impacts on different EM economies. How have you interpreted the move lower in terms of its impact on EM assets and the outlook for various EM countries?
For now, where we are, Brent hovering around 80 and change, it tends to be positive because, remember that, before the Middle East conflicts started, we were having, some of the short-term forecasts they were pretty much calling for 105, 110, right? It never happened. We never had this super spike, which is, I think that when we talk about spikes in oil, it tends to be more detrimental than beneficial to EM assets, despite the fact that EM, especially the Euro bond asset class, is actually quite oily. So I think that where we are now, it tends to be positive for central banks. But it goes back to my comments on the non-core performance of CPI, right? If we start, heading south with faster speed, I think that the rhetoric about a faster cool down in the world, that will probably come back, and that tends to be a little bit more negative to EM. But for now, I think that I would, despite the fact that everything that's happening in the Middle East, of course, it tends to be a little bit like a sweet spot for assets now.
Okay.